one. All right, we're live. This is an emergency episode of the Equity Accelerator podcast. I'm your host, James Adair with Sierra Pacific Mortgage, and I am thrilled to be joined by Jay Promisco, who is basically the head guy at the whole operation. He's the chief of production, so everything kind of rolls up to him that pertains to mortgages per se. And it's the reason why I wanted to do an emergency episode, and I think I'll try to be doing this at least once a week for the foreseeable future, just to help my local real estate community get good information about what's happening in the mortgage space, in the credit space, because this pandemic situation is just it cuts across every industry. We're no different. I guess I learned from memos that just came out from Gary Clark that we are what kind of business are we considered, Jay?
We're an essential business.
We're an essential business to be in the banking. So I'm from my COVID-19 bunker in Southeast Portland. You're in the office right now with like two other people in our, how many people work at Sierra Pacific Mortgage?
We have 770 employees. I've got 5 of them working in an office right now. Everybody else we sent everybody home.
Yeah.
And frankly, we're in a business, thankfully with the technology, we're actually open, operational, working through some broadband issues and
I know.
And kids running around in the background issues, but
yeah, if you hear the beeping in the background, that's my daughter on her hoverboard, because this is just a corner of the basement, and like people are kind of running around here. So right. This is going to be where I'm kind of improvising, but I think I wanted to make this really tight. You're one of the smartest guys I know around the bigger picture of mortgages. I just know how to sign people up for mortgages and explain how it affects their lives as a borrower and a homeowner. But there's this whole ecosystem of capital that happens behind the scenes. And all that stuff is in a kind of a state of chaos right now. And one of the things, a lot of people are calling me right now. I'm recording this on the 20th of March. And people are calling me all week. Hey, I heard rates were low. I heard the Fed cut rates to 0. Like, let's refinance. But mortgage interest rates are spiking right now. And I wanted to see if I could get your input on why is that happening?
Yeah, we're really, unfortunately, in this perfect storm. When you look at mortgage as a whole, I mean, there's the good things that happen, which is, getting people into homes, you're refinancing them, you're all these things. At the end of the day, why mortgage exists is there's this thing called an MSR, a mortgage servicing right. And investors buy mortgage servicing rights to guarantee a stream of income, an interest rate of return on their capital for a period of time. Right now, we have some uncertainty around what that stream of interest payments is going to look like here going forward. And you have the other, so we have uncertainty around the valuation of servicing right now. And then you have really a fear of these asset buyers going in and purchasing mortgage. And if the economy doesn't recover, what does the unemployment figure look like? If I issue this mortgage today, 60, 90, 120 days from now, are these people going to be employed? Can they make their mortgage payment? And I unfortunately, and for you veterans, you've lived through this before. Back in 07 and 08, it was a very similar, risk versus reward scenarios for mortgage-backed securities. There's a lot of unemployment, a lot of businesses went under, a lot of people got stuck. The difference is the quality of the paper today, the quality of mortgages is so much better. We really cleaned that up.
Yeah.
But the problem is, even if you have an 800 FICO score today, you have $50,000 in reserves. Well, how long is that going to last you if you're unemployed? And so there's just really a lot of uncertainty there. And why these rates have shot up so fast is most investment banks, private equity firms, some of the big aggregators of servicing, some of the bigger aggregators of assets in general have moved to an all cash position because of the uncertainty. So rather than deploying capital and buying mortgages today, everybody is kind of going, well, I'm just going to hold on to my cash right now and kind of ride this thing out and see what happens.
This is what it looks like when everyone sells at the same time.
That's exactly right. And so there's very little liquidity. Um, a few times this week, there was very little activity in the buy side equation, and the Fed stepped in, and they've stepped in 3 times already. Additionally to the 200 billion they decided to buy last week, today they announced they're going to buy another 32 billion today. This morning rates were off like 200 basis points. Here I am 4 hours later, and they're 100 basis points better than the morning open. So
it was a 300 basis point swing. That means the same rate yesterday. If we lose 300 basis points in the market on the mortgage-backed security side, the rate that was yesterday it cost 0 points to the borrower. Today costs 3 points to the borrower. So that's a huge shift. Normally it would take 6 months for that kind of shift to take place, and it happened in 4 hours.
Yeah. And unfortunately that, normally our borrowers and loan officers are available like, okay, well, I can take your rate up and I've got this premium pricing and I can pay down some of your fees. Unfortunately, nobody wants to pay up for servicing at all.
Right.
And really anything that's, call it a 4% rate or above, is kind of worth zero right now, because again, there's no way to value the asset. Premiums, all the note rates have all started to compress. And
I've noticed that for the cash out refinances, for the non-owner occupied pricing, is really, there's no premium to absorb. Those are the 2 types of residential loans that command the highest price. And you pretty much just have to pay points, and sometimes a lot of points, to get that loan today. But I'm thinking of, like, when will this normalize? Like, is it reasonable for me to, let's just wait and see what happens. Let's not lock anything right now. Let's maybe lock in a week or a month or 2 months. Like, what's the good advice right now on that?
Yeah, markets as a whole, and you take mortgage outside of it, even equities, the debt market, commercial real estate in general, volatility makes it really hard to have any kind of sense of on pricing out an asset. Right now, I mean, the whole country is going through something that nobody has ever seen before. And there is a lot of fear around liquidity, around cash positions, around employment, until we see some sense of stability, right? And so if nationwide, I'm in California, we're on this lockdown right now, and they haven't given us a date when, all clear, you get to go out and do your normal chores. The date run around there is April 7th. Will that hold or not? It'll really depend on if people take this thing seriously, they stay home, they do all the things that we're asking them to do. If they do those things and we don't stretch this thing out for another 60, 90 days, maybe we're in good shape. But in between here, in that time period, the only thing that I can see that where an investor is going to feel comfortable is if the Fed is willing to step in and start buying MBS at this time. It's the same. Their Fed they're providing funds, short-term capital rates, repo. They need to figure out how to keep some of these small self-employed businesses intact. I mean, they're going to be offloading a lot of funds. And my fear is we're already in a big, huge deficit right now, and you're going to extend that deficit. What does that look like 6, 8, 12 months down the road? What I encourage everybody is, if you've got a borrower and you're purchasing a home and they really want this home, get into that home, right? Yeah. And you may not like the rate today, but you might really not like the rate 3 months from now, right? Generally, when you flood the market with cash, you take on a lot of debt. That usually pushes you into an inflationary environment, and that generally would mean higher interest rates later. So,
well, also, I think I guess I am kind of an expert. I've been doing this for 17 years, but I'm not an economist, but it seems like one of the key differences this time with this type of financial crisis is that it's not necessarily going to be in real estate. Like we will see some disruption and some dislocation in real estate, but I mean, part of the fiscal response is going to, I mean, the foreclosures that are COVID related, are they even going to be foreclosures? I mean, we might not see real estate supply flood the market like it did last time when people just got upside down and handed the house back to the bank.
Yeah. Yeah. It's definitely not housing related. If you took the unemployment potential out of the equation, housing and mortgage would be strong for a very, very long time. Unfortunately, this has been such a rapidly moving environment. The agencies, Fannie, Freddie, HUD, VA, haven't had time to sit down and think and say, hey, what do these long-term strategies look like? And for example, last couple White House briefings, that we had one that said, hey, look, there's going to be, 2 months of no mortgage payments for everybody. And unfortunately, they didn't tell anybody that owns mortgage that was going to be the case. We have $17 billion in servicing, and they didn't tell us that we were going to have to pay $17 billion worth of mortgage payments over 2 months. So now they did also release that recently we've been notified that rather than move into accelerated foreclosures at anybody that aggregates servicing, they're going to encourage us to revisit things like loan modifications, foreclosure forbearance for a period of time. All that sounds wonderful for the economy. I mean, I think that's the right thing to do, but it does nothing for the valuation of a mortgage-backed security. And all that tells me then, and people that do what we do is like, well, I would take on that additional risk in that somebody would eventually default, but it's going to come at a price. And so that's how more risk is going to, probably encourage a higher interest rate long term.
You think we're heading into a higher interest rate environment at some point this will be reflected. I mean, it's basically reflected in the rate sheet right now. Mm-hmm. But once we normalize, if people's jobs can come back, I don't know. Before we get off this topic, this is going to be a huge hot button for a lot of our listeners. I've already had people emailing me about, hey, I heard we can have forbearance on our mortgage payments. How do I apply for that? I heard on NPR that people are not having to pay their mortgage. What is that going to look? I saw a headline. I didn't read the article, but of course, in my social media feed, one of my mortgage lender buddies posted something saying Bank of America is going to let people pause their mortgage. And I guess you make it sound like we still have to make these payments. If we let borrowers not make the payments, Sierra Pacific the servicer has to make the payments. But what if it's a true pause where it's like we just defer three payments, and then just add it to the end of their loan? So we kind of just skip forward on, in time, but they're on the same amortization schedule, et cetera. Is there what's the negative ramification of that?
That's less of a negative ramification than telling, we're well capitalized as a company. And so with the amount of servicing we have, forwarding mortgage payments, we could probably figure that out. Some of the larger aggregators, there's a couple, really big aggregators of servicing where they have $600, $700, $800 billion worth of mortgage servicing, and they're independents. They don't have a cash position large enough to make that differential. So likely, if the federal government decides, yes, this is the route we're going to go into mortgage forbearance. And I don't think mortgage forbearance is for everybody, because there's some people that are gainfully employed. There's some people that are making plenty of money in this market. I don't, it can't be one size fits all. I think it's going to be a real surgical transaction. And if you have borrowers, if you're impacted by this, the best thing you can do right now, if you think that you're going to have an issue making your mortgage payment, is get a hold of your servicer and say, right now I'm having issues. What are my options? And at least you're being proactive about it. Mm-hmm. Worst thing you can do is run and hide and just assume what you're hearing on the news is the right call.
Right. I think
so.
anybody who's listening to this, in particular if you're in the industry and you have clients that are asking you questions, if you're a leader in the real estate space, do not tell your client not to make the mortgage payment. I think that could be very detrimental. No one is scaled up to, no one has a specific program that's allowing this to happen. I think if there is such a program, and hopefully we can update people as news comes out on this, but if there is such a program, I imagine it would be, you'd have to verify that your income has been impacted and apply for some kind of forbearance. I don't know what it's going to do to your credit. I don't know what it's going to do, because I remember when loan modifications were happening, people got their credit just like shredded and didn't mean to, they didn't realize it. And there was all kinds of shady operators that stepped in and were like, hey, we'll do a loan mod for $3,000. And it was just a disaster. So I hope that type of dynamic does not develop. But
yeah, I think that's,
be clear.
James, I think that's important. Unfortunately, when in times of crisis, and there's a whole bunch of people that try to take advantage of the situation. And so my advice to borrowers, realtors, and if you hear something on the news, you hear something from a company and it sounds too good to be true, it probably is. Double check that information, call James Adair. This is where we're being a loan officer, we're a fiduciary to the community. And in this type of situation, go find somebody that knows what they're talking about, somebody that's vested in the long-term success of the customer, which we are. Get the right information before you act, right? And in this situation, it's going to be really hard for realtors and for loan officers to say to borrowers, like, maybe right now is not a good time for you. That might be a lot of times that's going to be the right answer. And it's really hard to say no when you're looking at, the potential revenue that could come in. So
I have definitely said that to a client this week, where I'm just sort of like, we're doing a loan application. We're going to kind of assess their options and everything as normal, but they're renting right now. And I'm like, hey, if you can afford to see where we're at in a couple months, like if you can afford to wait, maybe you should just wait, like I feel a real sense of urgency in being like, yeah, go buy a house in this market. It's going to be awesome. But I also have the sense that, like you said, if you're in contract right now and you're feeling like just really nervous about moving your family in a pandemic, I think there's a good argument to be made that it will be significantly more difficult to buy a house 3 months from now, 6 months from now, because a lot of people who are planning to put their home on the market this spring are panicking and not putting their home on the market. And rightly so. If you can afford to wait, again, maybe they're going to wait. But I think there will be a huge bottleneck of pent-up demand and and maybe inventory will go close to zero for a time in months to come.
Yeah, somebody told me they were on a trading desk this morning that, we were talking about the purchase market. And frankly, if I'm going to be quarantined for an extended period of time, I want to do that in my own home. And there's, as long as you're looking at your house as a home, you're not looking at it as an investment vehicle for my retirement later. If you use that calculus, then it's always a good time to buy a home, right?
I'm an absolute just zealot about home ownership, and I think even buying a rental property right now is still, you'll come out ahead in the long term. It will be bumpy this year in ways that we maybe don't even recognize yet, but if you're in contract, again, if you don't like the mortgage, you can always refinance later. The 30-year fixed is a little volatile right now, but I've found that 20-year pricing has been a little bit less volatile. 7-year ARM has looked really sharp lately. So, there's ways to deposit your risk in a different place that gives you a strong operating area today. So
that's part of that inflationary pressure, James, in the risk-based pricing. where do I want to tie my money up as an investor into a 30-year vehicle, knowing that if you're in an inflationary market, why would I invest in something at 2.5%, lock it in for 30 years, when 2 years from now that thing might be 6 or 7? So shorter duration securities are trading much better. There's less volatility in those. So if you're looking at 5, 7, 10-year ARMs, you're going to see better pricing in there. So
yeah, that has not been true. I mean, for the last, who knows, I haven't even looked at ARM pricing until a week or two ago, because the ARMs were, yeah, the ARMs were like a quarter higher in rate than the 30-year fixed, and like with the 30-year fixed was whatever 3.75. Like, why wouldn't you just grab that anyway? But things are changing rapidly. Call your servicer if you're going to have trouble making your payment. Don't just listen to NPR and stop making your mortgage payment. That's what we can. Those are definite takeaways from this right now. Any parting thoughts for the week? What should we be thinking about this week as we are all quarantined?
This week I'm encouraging our company. I'm encouraging everybody I know in the industry to kind of take a breather, go home, spend some time with your kids, stay away from people that are at risk and could cause problems. The worst thing I think we can do is panic. I've never seen that strategy work ever. I do know, having done this a very long time, at some point this subsides. At some point we deal with the ramifications of what just happened. So there'll be an economic impact of some sort. There's this existing pool of borrowers today that are in your pipeline that can refinance, that really need real estate agents, lenders' help right now. This is an opportunity, excuse me, for the mortgage business to come back and say, look, we're here for you. We're not just trying to hurry up and get you into a home. Our job in this industry is to do more than just refinance people, right? And so take a pause, relax. At some point, this is going to be very stressful, and it's going to, for the next 60, 90, 120 days, it's going to be a little bit of a game of darts, wondering where it's going to end up. But be visible online, 6 feet apart, but be intentional about the people you're talking to. This too will pass.
This too will pass for sure. Yeah. I believe that, and I believe, in the words of Dan Rawich, it's hard to bet against the Fed when the Fed wants what it wants.
Yeah, it's a pretty, we do live in the United States. We still are the largest economy in the world. We still have more dry powder than any other country in the world. We have a vibrant, aggressive, very, very powerful workforce here, and we'll figure out how to get these people employed again. Right now, I'm thinking about the bigger picture.
This is like a wartime. This is like we're all going to war together by staying home. This is like a war effort. That's how I'm looking at it.
Yeah, I saw a meme I thought it was funny. It's like, we asked, in the 40s, we asked everybody to go storm Omaha Beach. I'm telling everybody to stay home on their couch. Yeah. I think we can do this.
I know. No one stays home and sits on their couch better than the United States of America. That was a good tweet I saw. So stay home, everybody. Stay safe. Wash your hands. Don't touch your face. Social distancing. I'm going to wrap this thing up. Jay, thank you so much for your time and input. I'll be coming back to you again in the future to update us on how things are developing.
Thank you, James.
All right. See you later, everybody.